Did you know that despite a major regulatory repeal, your DeFi transactions are still fully taxable? And the I.R.S. is watching? Many crypto users mistakenly believe that the recent changes mean they don't have to report their DeFi activities. But that couldn't be further from the truth. In fact, ignoring these rules could lead to significant penalties. In this video, we're going to break down exactly how the I.R.S. taxes common DeFi activities like token swaps, staking rewards, and liquidity pool income for the 2026 tax year. You'll learn about the critical responsibility gap created by a recent law, why self-reporting is more important than ever, and how to avoid costly mistakes. Stay tuned because understanding these rules is essential to staying compliant and protecting your crypto portfolio. Let's kick things off with a crucial update: the DeFi broker reporting repeal. On April 10, 2025, President Trump signed H.J.R.S. 25 into law. This historic move used the Congressional Review Act to overturn the Treasury Department's DeFi broker reporting rule. Now, this rule, finalized in December 2024, would have forced DeFi front ends and protocols to issue Form 1099-DA to you and the I.R.S., but it's gone. What does this mean for you? First, DeFi protocols will not be issuing 1099 forms for the foreseeable future. Second, the I.R.S. can't just propose a similar rule without new congressional approval, thanks to the CRA provisions. However, here's the critical part: your individual tax obligations are completely unaffected. The repeal only removes the reporting burden from the protocols, not from you, the individual taxpayer. This creates a massive responsibility gap. Centralized exchanges will still issue 1099-DA forms starting in 2025. But for DeFi, you are fully responsible for self-reporting every single transaction. The I.R.S. still has sophisticated blockchain analytics tools and can trace on-chain activity right back to you. Now, let's dive into specific taxable DeFi events, starting with DEX swaps. Every single token swap you make on a decentralized exchange, think Uniswap, SushiSwap, Jupiter, or Radium, is a taxable disposal. The I.R.S. considers cryptocurrency as property, just like stocks. So swapping one token for another is treated exactly like selling one stock and immediately buying a different one. Here's an example. Imagine you swap two ETH that you bought for $3,000 each for 10,000 USDC on Uniswap. Your proceeds from this swap would be $10,000, which is the fair market value of the USDC you received. Your original cost basis for those two ETH was $6,000. This means you just realized a $4,000 capital gain. Whether this gain is short-term or long-term depends on how long you held that ETH before the swap. And here's a small silver lining. Gas fees you paid for the swap can be added to your cost basis or treated as a selling expense, which reduces your taxable gain. This is based on I.R.S. guidance that qualifies gas fees as digital asset transaction costs. Next up, staking rewards. This is a big one, and it trips up a lot of people. According to I.R.S. Revenue Ruling 2023-14, staking rewards are taxable as ordinary income. The key is that they are taxed at the fair market value of the tokens at the exact moment you receive them. And receive means when you gain dominion and control over those rewards. For most proof-of-stake networks, this happens when the rewards hit your wallet. So what are the key takeaways here? First, staking rewards are ordinary income, not capital gains. This means they are taxed at your regular income tax rates, which can be much higher than capital gains rates. Second, you owe tax when you receive them, even if you don't sell them. This can create a phantom income problem where you owe tax on assets that might later drop in value. Third, the fair market value at the time you receive the rewards becomes your cost basis for future sales. If you later sell those staked tokens, you pay capital gains tax only on any appreciation above that specific cost basis. For the 2025 tax year, ordinary income rates can range from 10% to 37% depending on your tax bracket. High-income earners might also face an additional 3.8% net investment income tax. Now, let's tackle liquidity pool deposits and withdrawals, which are notoriously complex. Providing liquidity to an automated market maker, or AMM, like Uniswap, V3, or Curve, involves some nuanced tax considerations. When you deposit tokens into a pool and receive LP tokens in return, this might be a taxable event. As of early 2026, the I.R.S. hasn't issued specific guidance on the exact mechanics of LP tokens. However, the prevailing conservative interpretation treats the initial deposit as a taxable exchange. Why? Because you're essentially swapping your underlying tokens, say, ETH and USDC for a new asset, the LP token. This exchange could trigger a capital gain or loss, just like a DEX swap. This is a critical point, because many users don't realize that simply providing liquidity could create an immediate tax liability, even if they haven't sold anything in the traditional sense. It's a deemed disposal, and you need to track the cost basis of the tokens you put in and the fair market value of the LP tokens you receive. Moving on to other common DeFi activities, airdrops and yield farming. Airdrops, where you receive free tokens, are generally taxed as ordinary income at their fair market value on the day you receive them. It doesn't matter if you didn't buy them, the I.R.S. views them as income. The value of the tokens at the time of receipt becomes your cost basis for any future sale. If the token's value goes up after you receive it and you then sell it, you'll pay capital gains tax on that appreciation. Similarly, yield farming income, the extra tokens you earn from providing liquidity or staking in a farming protocol, is also typically treated as ordinary income. The fair market value of these earned tokens at the time you gain control over them is what you report as income. This means if you are actively yield farming, you need to meticulously track every single reward you receive, its date, and its market value. This can quickly become an accounting nightmare, especially with frequent rewards or volatile token prices. Remember, the I.R.S. isn't distinguishing between earned income and gifted income in the crypto space. If you receive it and it has value, it's likely taxable. So we've talked about the repeal of the DeFi broker reporting rule, but let's be crystal clear about the responsibility gap this creates. While centralized exchanges will begin issuing 1099-DA forms for your 2025 transactions, DeFi protocols will not. This means the entire burden of tracking and reporting your DeFi activity falls squarely on you. The I.R.S. isn't saying these transactions are untaxable. They're simply saying the protocols don't have to tell them directly. But make no mistake, the I.R.S. is not blind. They have access to sophisticated blockchain analytics tools, and they can and do trace on-chain activity. If your on-chain footprint doesn't match what you report on your tax forms, you're at a high risk for an audit, penalties, and even interest. This is why accurate self-reporting is absolutely non-negotiable for DeFi users. You need a comprehensive record of every swap, every staking reward, every LP deposit and withdrawal, and the fair market value at the time of each transaction. It's a daunting task, but it's essential for compliance. Given the complexity of DeFi taxes and the responsibility gap, how can you stay compliant without spending hundreds of hours on spreadsheets? This is where tools like dTax become invaluable. dTax is designed to automate the heavy lifting of DeFi tax reporting. It supports 22 different blockchains, including 16 EVM chains like Ethereum, Polygon, and Avalanche, plus Bitcoin, Litecoin, Dogecoin, and Solana. This means it can track most of your DeFi activity across various networks. dTax automatically identifies and categorizes your DEX swaps, staking rewards, LP deposits, and even airdrops, calculating the correct capital gains or ordinary income for each. With 13 different cost basis methods, including FIFO, LIFO, and HIFO, it can even help you optimize for the lowest possible tax bill. Instead of manually tracking every transaction, dTax syncs your wallets and exchanges, generating the necessary tax forms and reports to send to your CPA or file yourself. It takes the guesswork and the headache out of DeFi tax compliance. Check out getdtax.com. It's open source and free to start, allowing unlimited imports and 5 AI chat questions per day. Let's answer a few common questions about DeFi taxes. First, does tax loss harvesting apply to DeFi? Absolutely. If you have capital losses from DEX swaps, you can use them to offset capital gains and even up to $3,000 of ordinary income each year. It's a powerful strategy, just like in traditional finance. Second, what if I made a mistake in the previous year's DeFi reporting? It's always best to amend your tax returns as soon as you identify an error. The I.R.S. prefers that you self-correct rather than waiting for them to find it, which can lead to higher penalties. And finally, are gas fees always deductible? Yes. I.R.S. guidance confirms that gas fees related to taxable transactions, like DEX swaps, can be treated as transaction costs, either added to your cost basis or as a selling expense to reduce your gain. However, gas fees for simply moving assets between your own wallets are generally not deductible. So there you have it. The world of DeFi taxes is complex, and the repeal of the broker reporting rule has placed an even greater responsibility on individual crypto users. Ignorance is definitely not bliss when it comes to the I.R.S. Remember, every DEX swap, every staking reward, every liquidity pool deposit, and every airdrop is a taxable event that needs to be tracked and reported. Don't fall into the trap of thinking that because protocols aren't reporting, you don't have to. Stay diligent, use the right tools, and protect your financial future. If you found this video helpful, please give it a like, subscribe for more crypto tax insights, and share it with your fellow DeFi enthusiasts. Thanks for watching, and see you in the next one.